Hi, I'm Jimmy. In this video, I'm going to walk through my analysis of Verizon Communications, ticker symbol VZ. This is the 27th video in our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. We're then going to take that analysis, we're going to build three different portfolios, a dividend, a value, and a growth portfolio. You can see a link in the description below to all the other videos we've done so far. Okay, so Verizon's business can be broken into two main segments, wireless and wireline. And as we can see, the wireless segment is the largest segment by far and accounts for about 76% of the revenue during 2018. And the wireline segment accounts for the other 24%. So let's start with the wireline segment. The wireline segment provides data and video services, networking solutions, security, and voice services. Now, we all know that this segment of their business has been shrinking in recent years, which is why Verizon has been focusing their wireline efforts on their fiber-based network under the Fios brand. This is a chart of revenue for the wireline business going back to 2009. And as we can see, it's been trending lower for a long time. This big drop right here, well, this is when Verizon sold a piece of their business to Frontier Communications. And revenue has continued to trend lower ever since then. Now, let's jump over to the wireless segment, which is where the real growth potential is. And this is revenue for the wireless segment. And I actually found it quite interesting that revenue was trending higher for quite some time. And then in 2016 and 2017, revenue began to pull back. And then once again, in 2018, we saw a nice jump. Now, if we switch over to the company-wide revenue, this is what that looks like. And as we can see, total company revenue looks very similar to the wireless segment, thanks to the dominance that the wireless segment has on total revenue. Now, let's look at a few more numbers before we go ahead and try to value Verizon's stock, and then we'll dive into some key developments that have been happening to Verizon and to the industry in general, and some key points that I think we should watch going forward. So up next is net income. And as we can see, net income looks great, especially when we consider that revenue struggled to get to the old 2015 highs, and net income went flying right by those highs. So when we see this, we know that net income margins must have gotten better. This is what net income margins look like going back to 2009. And as we suspected, margins have gotten significantly better. Now, personally, when I see this, I want to know, why is this happening? Are they raising prices? Are they cutting expenses? Do they have more effective marketing? So I dug in a bit, and it seems that Verizon has been they've been pushing the fact that they've been trying to lower operating costs. In fact, when they announced their 2018 earnings, they beat analysts' expectations with better than expected margins, which in theory implies that they are doing a good job of cutting operating expenses. Along these same lines, capital expenditures came in lower than analysts expected as well, which also led to stronger free cash flow. And with that in mind, it makes a lot of sense to try to use free cash flow or discounted cash flow to try to value Verizon stock. So how about we start there? So this is Verizon's free cash flow going back to 2009. And the first thing that jumps out to me is how volatile it is. And this type of volatility will actually make it trickier to use discounted cash flow to value Verizon stock, since what we're really looking for is we're looking for a very stable free cash flow. Let me show you what I mean. So when we add analyst projections to this chart, well, we can see that analyst free cash flow expectations going out the next few years is fairly stable. And we know that it's unlikely that free cash flow will shake out the way that analysts are predicting it. And we can tell that by simply looking at the previous 10 years or so and look at that volatility. How is it going to stabilize so quickly? But as an analyst, I understand that it can be very difficult and almost impossible to predict the various changes in capital expenditures or incoming cash to come up with free cash flow with any extreme accuracy, especially in a rapidly changing business like Verizon's business. Okay, so let's see how our valuation of Verizon stock shakes out using the discounted cash flow method, and then we should probably go ahead and try to value VZ using a price to earnings multiple as well, just so we could double check our fair value, since we know that this one's volatility makes it a bit shaky at best. So the first thing we need is a discount rate. And as we can see here, I elected to use 9% for a weighted average cost of capital. I have a growth rate of 2.5%, which gives us our fair value, and then we divide that by the shares outstanding, and we end up with a fair value for Verizon stock of about $73 per share. Now, just so we're all on the same page, let me try to break this down a bit. So for the weighted average cost of capital, we elected to use 9%. To come up with that, this is what the formula looks like. And as we can see, the weighted average cost of capital actually came in at 8.4%. I rounded it up to 9% just to be a bit more conservative, because the higher the cost of capital we use, the lower the fair value will be. Now, if you were wondering how to calculate this, I actually have videos on this type of thing in the description below, so you might want to take a peek at those if you're not sure how to come up with these numbers. The cost of debt is actually quite simple. You could just get that from what they pay on their bonds. You weight that. Cost of equity is a bit trickier. For that, I use the capital asset pricing model. Once again, link in the description below. Next, we use 2.5% for the perpetual growth rate. And this perpetual growth rate is important because it helps us come up with the terminal value. And the terminal value for this type of valuation is crazy important. Basically, what the perpetual growth rate does is it tells us how much are things going to grow forever. So it's actually off of what we could see on this chart. But after that, we determine how much is free cash flow going to grow forever. We say 2.5%. It's a reasonable number to use. Typically, they say that you should use something that is about in line with the average growth of GDP. Typically, I see most people use between 2.5%, 2.5% and 3%. I liked it for 2% because, again, it's a bit more conservative to use a lower growth rate. Okay, so we have a fair value of $73 per share for Verizon stock using the discounted cash flow method. How about price to earnings? Well, right now, Verizon stock is trading at a forward PE of about 12x. Their 10-year average for their forward PE is a bit over 13x. Now, if we jump back to the net income margin chart, well, we can see that margins have drastically improved quite consistently over the past years, which tells me that Verizon should probably be trading at a higher multiple than their 10-year average, since margins are now better than they were over the past 10 years. So if we were to use 14x, which seems like a reasonable number to use based on their improved margins, well, that would give us a fair value of Verizon stock of about $65 per share. Right now, Verizon is trading at about $57 a share, so 65 looks decent, and 73, based on the discounted cash flow, looks even better. Now, one final thing I want to bring out around the future of Verizon is that Verizon has been pushing hard towards 5G, which they believe will be the next big driver of growth for their business. And this is important because it hasn't been all good things for Verizon in past years. They bought AOL, and then they bought Yahoo, and neither one of them panned out the way that Verizon would have hoped. They closed on the Go90 mobile streaming platform back in 2018, and that hasn't worked out completely the way they've wanted to up to this point. Yet on the flip side, free cash flow has gotten stronger in the past few years, and that has led to continued dividend increases. Now, many analysts are expecting for Verizon to be able to roll out 5G, and they expect that that will in fact improve growth for the company. So overall, I'm a big fan of Verizon. And from what I've read about 5G, it seems that it can shake out to be all that Verizon's hoping it will be. And if this does happen, well, it could push Verizon's revenue and profits into an extended growth period, which would be great for Verizon stock and could ultimately lead Verizon stock to hitting the low end of our range of $65 per share or the high end at $73 per share. But what do you think? Should Verizon stock be added to any of our portfolios? They have a dividend yield of about 4%, which makes VZ stock, in my mind, a shoo-in for the dividend portfolio. I think I also like Verizon for both the value and the growth portfolio. But what do you think? Is there anything that I missed in my analysis that we should consider, and either that will keep it in the portfolio or take it out? Let me know what you think in the comments below. And thank you for sticking with me all the way to the end of the video. If you haven't done so yet, hit the thumbs up, hit subscribe. I'll see you in the next video. Thanks.